Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another Velocity Banking review. And before we get started with our Velocity Banking review, first question I have to ask, like, why'd you click this video? The thumbnail says this is a brainwashing cult, so I'm curious why you clicked the video unless you actually want to be brainwashed, which we'll try to do here today. And if you don't know who I am, who is your brainwashing master? Who is the cult leader? Well, I'm some dude who paid off a mortgage in 2 years and 9 months, and I just casually say that, paid off a mortgage in 2 years and 9 months. I know for some of you that might be shocking, but to other people, it's like Tuesday, you know? Once upon a time, you probably heard this story because you're going to hear me say the same stories over and over again. I met a dude with $2 million in a checking account and he just showed me on his cell phone. He says, I'll loan it to you. I'm like, what? I think I had a little bit of shell shock there. And I repeat this story because I've never had it happen to me again. I'm pretty sure I could call him up and say, hey, lend me the 2 million, but I don't know what to spend it on because I'm not that sophisticated. All right, velocity banking. So let's go ahead and get started with the review. And what is it? It's basically a debt payoff strategy where instead of trying to save money to pay off debt, which is kind of a contradiction, you're throwing all of your money to debt and you're using lines of credit to make it easy to help pay off debt, right? So there's a common theme here when I talk about paying off debt is that you're essentially not going to save money while doing it. And you're going to use a line of credit, or I use the line of credit to help me manage my cash flow and finances, right? And so, first step, excuse me, to doing velocity banking is a budget because your budget is your debt attack plan, right? So you have your income, your expenses, your leftover savings, and then you have your expense breakdown. And so one of the things that you might ask is like, hey, wait a minute, isn't this the same situation you did in like the last four videos? And my answer to that is actually I have two answers. I have the answer that makes me look good versus the answer that makes me look bad. So the answer that makes me look good is remember that Bruce Lee quote where he says, I fear the man who does one kick 10,000 times? Well, that's why I keep making the same video over and over again. Right. And the second type of answer that makes me look bad is like, well, I paid off a mortgage in 2 years and 9 months, so I just don't care anymore. Yeah. So pick your flavor of answer. But I think either one works because, some people they watch these videos and you're like, "You go so fast doing this," and I'm like, "It's because I did my 10,000 kicks." You know what I'm saying? Or one kick 10,000 times. Like I just did one thing 10,000 times. I have over 1,000 videos on the channel where I just kind of do the same thing over and over again, and people are like, "You're so fast! Like slow down." I'm like, "Why don't you just practice? Just do the same thing over and over again, right? Then you'll get it." Some motivational talk there. All right. So, budget, debt attack plan. In your expense breakdown, you list every single debt that you have, right? So, we have two credit cards, not a loan, student loan, a mortgage. And then here you have your personal operating expenses. So, basically, things know you have to pay for even if your debt is gone food, gas, insurance, right? Living expenses nowadays are crazy expensive. You go to the what's it called? Supermarket, you buy 4 things, it's like $100, you know what I mean? So, all right. So now we're gonna do the velocity banking side of the budget. So same income, same expenses, right? But here's the crazy part that people will freak out about. Number 1 is you're not gonna save money. You're not gonna save money. So how does this work out in practice? How does it look in real life? And why are people so scared is because when you log into your bank account, right? You don't see anything there, like this one right here, okay? See, you have money come in, and then you just don't save it, and then what you're doing is using all of your money to attack the debt that you have, okay? Now, I know some of you are looking at this, right? Some of you are looking at this. This is like, I don't know if you've ever seen those Ty Lopez, "Here are my garage" ads with the Lamborghini. Sometimes I like to think about that when I say, "Oh, look at this, 0 balance," and then you're, like, looking at this. And I know for some people it's like, "That's so little," right? Alright, well, yeah. So, the first step really is not to save money. That's like the core of one of the big cores and tenets velocity banking is you're just not going to save money. And then what we're going to do is try to maximize something called our cash flow. And so you see right here that you have zero savings, but you have this cash flow, right? And they look the same in the beginning, but then once we shovel some debt, this will actually increase without making more money. Okay. And what we're going to do is assume we have access to a line of credit. So, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again, right? So, a credit card is technically a line of credit. You pay, you swipe, you pay it back and then you use it over and over again, right? But then there's no credit cards aren't the only types of lines of credit, right? There's other types of lines of credit like home equity. This is like my home equity line of credit, $373,500 home equity line of credit. And then if we go here, we could see all the types of lines of credit that I have, 731,000. So I have a gajillion lines of credit, which includes personal lines of credit. Look at this one. I got this $20,000 line of credit recently. I haven't even used it at all. I should start using it because like the bank, they don't like it when you have idle lines of credit, but I gotta start using it. But here's the thing, right? A lot of people like, how do you get lines of credit? How do you get lines of credit? Oh my goodness, I learned about this velocity banking thing. And this is why you kind of need to have like a holistic education about money and credit because people think it's possible to be up to your eyeballs in debt and then get a line of credit. And you want to know the secret to getting lines of credit as a person who has over $731,000 in lines of credit? And they say that, the more I repeat one of two things, which is I paid off my mortgage in 2 years and 9 months, or I have over $731,000 in lines of credit, like one of those two. Okay. They say my ego grows. That's why I kind of just keep repeating myself over and over again, right? I just keep repeating myself over and over again. But the secret to it is that banks don't lend money to people who need it. That's the secret to getting lines of credit. So the way that I got all these lines of credit is I just went to a bank when I didn't need money. That's the truth. Like because the problem is that most people try to get the money when they need it, and the bank is a very risk averse institution. They're not an investor where they're taking risks on new ideas. They're what they're doing is they're lending to people who are very predictable, right? And people who don't need money are very predictable. R- You get a predictable rate of return, right? And so think of it from their point of view. Don't take a bit from yours, because a person who needs money is essentially the same thing. So, or actually, let me rephrase. A person who tries to get a line of credit when they need money, like in this instance, is like someone who crashes a car without car insurance and then tries to apply for car insurance. That's how they see you. See, like they see you as a very bad person because they know from statistics and history and, but I don't know if you would actually call it actuarial numbers or whatever, but they know, okay, they know that people who need money don't pay it back, right? So that's why they don't lend money to people who need it. Okay? Remember last time your friends or whoever borrowed money from you because they said they needed the money and then you lent it to them and they didn't pay you back? The bank as an institution has hard coded that lesson. Okay? So you have to understand that. And you actually have to give them what they want, which is a person who does not need money. All right. That's how you get all these lines of credit. Over 731,000. Who knows? Maybe in like a year or so, it'll be a million. I'm not in like in a rush or anything like that. Right. But they don't lend money to people who need it. All right. But let's assume in this example, we have over a $200,000 line of credit at a 7.5% interest rate. And I know what some of you were thinking, like, that is so unrealistic. And then, I'll say for you, right? But for me, I already got the $300,000 line. In fact, my last line was 280 at 7.5. And then I decided, you know what? I'm okay with getting an 8.5% if that means I could get more money. And so I did because I didn't need more money. See how that works? All right. So let's go ahead and do this. And so what we're going to do is we're going to shuffle some debt. Easiest way to know which debt to shuffle is use cash flow index, right? 30,000 divided by this. And then, I'm sorry, the formula is the statement balance divided by the minimum payment. And then it gives you a number. And then that number is essentially like a ranking system, right? So what we're gonna do is take the low ranking fruit and then move it to the line of credit and to increase our cash flow. So this is $65,000 of debt. Okay, so 65,000. And then guess what happens here? Oh my goodness. All right. Oh wow, this is insane, right? So $247 yeah, take a look at this. $247 of savings magically turned to $2,400 of cash flow. Oh my goodness, how is that possible when we did not make more money? What? And this is the part when you show most people, that's when they freak out and they realize they could have done things much better, right? Just one simple shift, increase your cash flow, and then make your line of credit as your main operating account, right? So what you do is you put the final step is you put your entire paycheck into that line of credit, and then you take your expenses out and then you rinse and repeat over and over again. See that $7,000 payment? People ask like, "Oh, does it work if it's biweekly or weekly?" Folks, that doesn't even matter, right? You're just putting all of your pay into the line of credit, which will satisfy the minimum monthly payment, and then it will lower the interest because the interest based on the average daily balance, and then you take your expenses out, and you're basically defeating the problem that the bank is trying to put you in, which is segregating your income. So the reason why you're saving so little is because when you get paid, instead of putting all your money into one place to make it effective as possible, you're splitting your money into like 20 different places up to wazoo, right? A little bit here, a little bit there, a little bit here, a little bit there, a little bit there, rather than just putting all of your money into one place. And then now what we're going to do is just do the calculation and do this. So I'm going to just do G2 plus H2 minus, what is it? 2434.87. And then what we're going to do is take the average daily balance, multiply by the interest rate, 0.085, and then divide by 12. And then what we're going to do is just copy and paste, right? Copy and paste. And all right, so 30 months, okay, 30 months, and it's all paid off. Whoa, so simple. Whoa, how we do that? The 65K of credit card debt, no problem, right? And the sad part is that the average credit card debt's only about 6 grand in this country, and which means that a lot of people aren't borrowing that much money, but because a lot of people don't make money, bank's not going to lend you 60 grand of credit card debt, and they certainly won't let you $731,000 lines of credit because they're looking for people who don't need money, and their hope is that the borrower is essentially going to be someone who makes money but doesn't know how to manage it, and and they don't want a person who doesn't know how to manage it at all. They just don't want someone who's like super 100% financial responsible. Big difference between those two, right? So, all right. So now we got 3 more loans. So we're going to do the loan calculator at 30 months. So what's the deal? 30, 30, 30. And then what we do is we have 12 grand here, 12 grand here, and then we're going to move it into the line of credit. So 12 grand here, and I'm going to do this. So that's the auto loan, and let me go ahead and add it to this month. So plus 1, 2 is 967.995. And because the auto loan is paid off, now this payment goes to 0. And then what we're going to do is re-update our cash flow to increase by about $400, right? All right, so this is going to be 2884.08, and then all right, I'm going to control and paste here, and then we see that in 35 months, this is all paid off. 35 months. All right, that's cool. 35 months, it's all paid off. So that's going to be 65 plus 25, and then it's going to be 90K. All right, next one is the student loan. So this could be 35, 35, and then this would be 0. So we have $77,000 in our student loan left, right? So after 35 months, let's go ahead and pay this off into the line of credit. And I'm just gonna do this. Bam, 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 alakazam, plus 77,638.52. And then what we're going to do is this is going to be 0, and then now it's 4 grand of cash flow. Okay, so now let's go do that right here, values. All right, and then this is going to be 4045.17, and then I'm going to copy and paste this, And then this is going to be 56 months. 56 months, this is paid off. 56 months. And then it'll be 190K. And then, all right, we're done with the mortgage. That was pretty quick. So this will be 56 months right here. And now that's 182,000. Now, if there's a big interest difference between the loan and the line of credit, got to be a little bit careful, right? In fact, the most important thing when it comes to purchasing, let's say a real estate with a mortgage, is that you get the lowest purchase price possible. Like for me, I don't even care if I get like an 8 or 9% like loan, as long as the purchase price makes sense. But the problem with most people is that they overpay, get a low interest rate, and they're looking for a monthly pay, the low monthly payment compared to the amount that they purchased, right? So people don't understand like buyer psychology when it comes to homes, but gotta be aware of that. But here's the thing: if you have a low interest rate and you're using a higher interest rate line of credit, and by definition, lines of credit will you have higher interest rates unless it's like in the introductory period. And that's because the interest rate represents two things. Number one is the risk that you represent to the bank. And then number two is the amount of access you have to the line of credit, right? So if you have full access to the line of credit, they charge you a higher interest rate compared to the one-way loan, which is why loans in general have lower interest rates. Okay. But just because you get a loan doesn't mean you want to move the whole thing into a line of credit. And the easiest way, kind of rule of thumb, is if it's low interest and high cash flow index, meaning that you get very little bang for your buck for paying off the loan, you don't need to move the loan into a line of credit. However, you can use something called chunking if you still want to use a line of credit to pay it off and prevent the segregation of income, right? Remember how when you're an elementary school kid, they said segregation is bad, but they did not teach you about segregation of income because bankers rule this country, okay? They don't care if racism solved, but if you pay off your debts too early, oh man, they're going to care about that. You know what I'm saying? All right. So, let's go ahead and then put this here. So we have this velocity banking calculator that I'm going to plug Renatus. I'm actually independent contracted marketer for Renatus. So if you're interested in not only learning about velocity banking, but also other things and possibly joining a cult, click the Google form link below. All right. So as you can see here, there's this chunk amount of $7,000, meaning that you're just recycling 7,000 into the line of credit over and over again, and it'll take about 3.3 years to pay it off. But do you want to move the whole thing into a line of credit? Well, it's still pretty quick in this case, but it's 25 grand versus 13. And the crazy part is, I want to show you something. You pay less with 30% interest with a small chunk. So that means you could actually use credit cards with this. And, maybe, you might say, oh, why would I pay like 17 grand versus like saving the most money? Because the best credit decision isn't the best financial decision. Maybe you're okay swiping your card $7,000 all the time, right? Maybe you're okay with that because once the bank sees that, whoa, this guy's paying off the credit card really quickly, think about it. They're probably going to increase your limit by bigly, okay? Possibly 731,000. I don't know for sure, but they might do it. All right, so let me go ahead and do this right here. 8%, paying off mortgages in 3.3 years. That's impressive, but I'm not that impressed because it's not 2 years and 9 months. No, I'm just kidding. Mortgage snob here. All right, so this is 0, and then now this is going to be 56 months plus divide by 12 plus 3.3. All right, 7.9 years, and then we are debt free. That's pretty sweet. All right. Okay. All right. Right. So, okay. So let me see. Yeah, I think that's it for today. Have I brainwashed you enough? Brainwash you to be debt free? That's the word of the day, brainwash. Brainwash, brainwash, brainwash. All right. Well, that's it for today, folks. This is Creating to Mentorship. If you made it to the end of this video, okay, and you're waiting for the secret code word to let me know you watched to the end of the video, write in the YouTube comment box below. Donkey Kong Country 2 is the best Donkey Kong game ever. Okay. And why am I saying that? It's because I recently played it on my Nintendo Switch 2. on the Super NES, Super Nintendo, Virtual Console, whatever they call it these days, and then I beat Donkey Kong Country 2 again, right? So what are you talking about? Well, I should write it, search for Donkey Kong Country 2, and that game is this game is a masterpiece, folks. Donkey Kong Donkey Kong Country 2. So, if you want a masterpiece game that you could play in your spare time because you paid off a mortgage in 2 years and 9 months, this is it, and I beat it, okay? So Donkey Kong Country 2 is a masterpiece. That's what I want you to write down below in the comment box, and I'll let you know. And that'll let me know you watched the end of this video because you're in a cult and you have to do what the cult leader says. Am I right? Wink, wink. Okay. Have a great day, everybody. I'll see you all in the next video.